For most of human history, silver wasn't just valuable, it was money itself, not a commodity, not an investment vehicle. Money, the kind of money that built empires, funded wars, and kept entire economies breathing. But today, you can buy an ounce of it for the price of a decent dinner. So what happened? How did one of civilization's most precious metals become so affordable? The answer isn't what you think, and the forces that made silver cheap are the same ones quietly reshaping your money right now. Let's go back to 1792. The United States passes the Coinage Act, and here's what it establishes. $1 equals 371.25 grains of pure silver. Not backed by silver, not redeemable for silver. $1 was a specific weight of silver. Gold and silver together formed a bimetallic standard, the bedrock of American currency. This wasn't some American invention. For thousands of years, from ancient Lydia to imperial Rome, from medieval Europe to Qing dynasty China, silver served as the primary medium of exchange for ordinary transactions. Gold was too valuable for everyday commerce, copper too cumbersome for large purchases. Silver occupied the perfect middle ground. By the 1800s, massive silver deposits in Nevada's Comstock Lode were transforming the American West. The metal wasn't just money, it was power, it was liquidity, it was trust made tangible. But beneath this glittering surface, tensions were building. Tensions between silver and gold, between debtors and creditors, between those who controlled money and those who used it, and these tensions would eventually break the system entirely. The bimetallic standard operated on a simple premise. Both gold and silver were legal tender at a fixed ratio. In 1792, that ratio was set at 15:1. 15 ounces of silver equaled 1 ounce of gold in monetary value. But here's the problem. Market ratios don't care about government decrees. When silver became relatively abundant compared to gold, people would mint their silver into coins and hoard their gold. When gold became more common, the reverse happened. This phenomenon, called Gresham's Law, created constant instability. Bad money drives out good money. Whichever metal was legally overvalued would flood into circulation. The undervalued metal would disappear into vaults and pockets. By the 1870s, this tension reached a breaking point. Major economies were choosing sides. Britain had already moved to a pure gold standard. Germany followed in 1871 after receiving massive war reparations from France. One by one, the dominoes fell. The crime of 1873. That's what silver advocates called it. The Fourth Coinage Act quietly removed the standard silver dollar from the list of authorized coins. The United States had effectively demonetized silver without public debate. Why did this matter? Because it meant silver was no longer money. It was just metal, just a commodity subject to supply and demand like wheat or cotton. The immediate effect was deflationary. With less money in circulation, prices fell. Debts became harder to repay. Farmers, who had borrowed money to expand during inflationary times, were crushed. The political backlash was fierce. William Jennings Bryan's Cross of Gold speech in 1896 captured the rage. You shall not crucify mankind upon a cross of gold. But the gold standard had powerful defenders. Creditors loved it. International bankers loved it. Britain's empire ran on it. And slowly, inevitably, gold won. By 1900, the Gold Standard Act made it official. Silver's monetary role in America was finished. Here's where the story takes a darker turn. Once silver lost its monetary premium, its price was determined purely by industrial demand and mining supply. No longer anchored to gold at a fixed ratio, silver's value could float freely, or more accurately, it could sink. Throughout the 20th century, governments still held massive silver reserves. The United States stored billions of ounces, but these reserves were being quietly sold off. Between 1959 and 1970, the U.S. Treasury sold approximately 3.9 billion ounces of silver. This supply glut, combined with silver's demonetization, drove prices down relentlessly. Then came 1965. The Coinage Act of 1965 removed silver from dimes and quarters. By 1971, it was gone from half dollars too. The last monetary link was severed. Silver was now just an industrial metal used in photography, electronics, and jewelry, but no longer money in any meaningful sense. What happened next reveals something crucial about value itself. In 1980, the Hunt brothers tried to corner the silver market, driving prices to $50 per ounce. It crashed spectacularly. Why? Because silver no longer had monetary demand supporting its floor price. It was purely speculative. For the next 4 decades, silver traded like any other commodity, experiencing booms and busts based on industrial demand cycles. The solar industry created new demand. Electronics consumed vast quantities. But the metal that once defined civilization's concept of money now fluctuated based on Chinese manufacturing data and semiconductor sales projections. The average price of silver in 2025, hovering around $30 per ounce, represents a catastrophic collapse in real terms when compared to its purchasing power in 1800 or even 1950. Adjusted for inflation, silver has lost approximately 90% of its historical value. Now here's why this matters to you today. The same process that demonetized silver is happening to your currency right now, just in reverse. Silver was removed from money, reducing its value. Your paper money is being removed from tangible backing, reducing its value. Central banks worldwide have printed more currency in the past 15 years than in the previous century combined. The M2 money supply in the United States has increased by over 40% since 2020 alone. This isn't conspiracy theory, it's public data from the Federal Reserve. Meanwhile, silver demand has actually been rising. Industrial applications, particularly in solar panels and electric vehicles, have created structural deficits. In 2024, the silver market ran a physical deficit of approximately 215 million ounces, yet prices remain historically suppressed. The paper silver market, through futures contracts and ETFs, trades over 100 times the actual physical metal that changes hands annually. First, understand that value isn't inherent, it's systemic. Silver didn't become less useful or less rare. The monetary system around it changed, and that change redefined its worth. Your dollars work the same way. Their value exists only within the framework that supports them. Second, demonetization is a policy choice, not a natural evolution. Silver was deliberately removed from the monetary system by governments and financial interests who benefited from that removal. The decision wasn't made in your interest. It was made in theirs. Third, patterns repeat. What happened to silver is happening now to cash itself. Physical currency is being phased out in favor of digital alternatives. Central bank digital currencies are being tested worldwide. The control that demonetization gave governments over silver pales in comparison to the control digital currencies offer over your spending, saving, and economic freedom. Silver was never meant to be cheap. For 5,000 years of human civilization, it was considered precious, valuable, and worthy of being money itself. Only in the last 50 years has it been reduced to something you can buy for $30. That transformation wasn't an accident. It was engineered. And the same engineering is being applied to every form of money you currently use. The question isn't whether your money will be worth less in the future. History has already answered that. The question is whether you'll understand why it happened before it's too late to do anything about it. If this video changed how you think about money, hit subscribe. We're breaking down the financial systems that shape your life, one hidden story at a time. And trust me, there are more stories like this one. Stories they don't want you asking questions about.